focus. Ideate, innovate, enable.
Welcome to the CNBC TV18 Investor Camp in Ahmedabad. It's a packed house here. I'm Reema Tendulkar. With me is Anuj Singhal. Anuj, 2015 didn't turn out the way we all thought it would do. Negative returns for the equity markets, earnings downgrade, the economic reform was slower than what was anticipated. But there are a lot of hopeful people over here that 2016 is going to be a better year.
Oh yes, on a Saturday morning to see so many people in Ahmedabad bullish about the market, 70% of them said that they are bullish on the market. 30 to 40% said that they have made money in 2015, which I think is great, which is telling you that stock-specific approach. That's Ahmedabad talking for you, but that's also telling you that stock-specific approach is going to work, Reema, in 2016 as well. The market has gone down 20% or thereabouts, but I've seen so many portfolios go up 20%. I've seen so many mutual fund NAVs go up 10 to 15%. It's going to be that kind of a market. The simple reason is that the earnings have not picked up, and that's why the index is struggling. But there's so much domestic liquidity. Every day the DIIs are buying, and where's that money coming from? All these people, and that money is going to continue in 2016. That's going to chase a lot of stocks in the broader market, and that's why a lot of money will be made in equities.
Yes, clearly it's been a stock selection approach which has done well in 2015 rather than a sector allocation. But Anuj, you look at the near term very closely. Very recently, we saw the Nifty revisit that 7550 mark, which was the 52-week low for the second time. We often call it the double bottom. Does that give you the sense that maybe we've put in the bottom, at least for the near to medium term?
I think the test of that would be next week, Reema, because next week, on Friday you saw most of the Thursday gains being given up. From next week, if you start to gravitate more towards say 7600 thereabouts, then there is chance of that mark being broken. But if you respect that mark, then at least in the near term, you should find support there. But my base case is that as we move towards budget, the market has one more round of selling left in it, purely because of the FI selling exhaustion. That hasn't taken place yet, and that is something which could drive the market lower. But again, at the same time, that's not going to prevent individual stocks from going up. But for the Nifty, my sense is that there's some more downside left in this market, which is then going to present a great buying opportunity because the earnings haven't picked up and they're not going to pick up for next 2 quarters. Market normally factors it in, say, 2 quarters in advance. So there's still some time to go, and my sense is that it's still not the time to go out and take large bets in index companies. Still time to maybe stick to a lot of mid caps, of course with your stop losses intact.
So let's kickstart the presentations by introducing the 3 speakers. We've got Nilesh Shah of Envision Capital, we've got Prakash Diwan and Kapil Bali of Yes Securities. To kickstart it, we're now joined by Nilesh Shah.
The year 2015 has been, so to say, a year of turbulence. There has been global turbulence. It's been a guessing game as to when the Fed would hike rates, whether it would hike rates or not. What would China do? What happens with some of the geopolitical issues cropping up in the Middle East? Back home in India, the monsoon again turned out to be a deficient monsoon, which in turn has dampened the buoyancy which India has witnessed in the rural economy. And we've seen, of course, continuous selling by FIs. But I think in the midst of all of this, there have been several stocks which have given outstanding returns. And I think 2015 in a way symbolizes what the investment world is. That wealth and returns are created and generated by individual companies. Markets are just a platform. I think the most important message of 2015 is the virtue of bottom-up investing, which means continuously to be looking out for companies which will grow, companies which will grow despite whatever is happening with the economy. In the last 18 months, a lot of work has been done in a lot of areas. And the economic implications of these will start manifesting themselves over the next quarters, over the next couple of years. And in the process, a lot of individual companies will benefit and benefit disproportionately. I think the big message is that the way of doing business has changed. It is not about somebody who had access to somebody in power and therefore is able to grow his business. It's about somebody who's willing to adapt technology, who's willing to change himself, transform himself, do something in a very, very different manner. And I think those will be the winners of tomorrow. The winners of tomorrow will not be companies which just create capacity and hope that somebody will come and buy. I think the winners of tomorrow will be those kind of companies which can be the least cost producers, which can basically cater to a very large audience, not just a local market, but a global market.
I think 2015 has been a year where the resurgence of domestic investors was witnessed, where we've seen unprecedented domestic liquidity step in to the Indian markets. I think that makes 2016 a very, very interesting year. It's a year where expectations are very, very tempered. The expectations are that global growth is going to be muted. There are concerns about China going ahead with devaluing its currency, and there are concerns whether big ticket reforms will happen in India or not. But I think in the process, what we've seen right now is valuations become extremely attractive. We're going to see the whole crash of commodities play out for corporate earnings, which will improve margins and drive growth. The second big phenomena that we see happening in India is a lot of focus which has been given on infrastructure in the last 18 months of this government will start manifesting itself in terms of increased activity, be it roads, rails, defense, ports, waterways, river linking. These are some of the big areas where you're going to see a lot of traction going forward.
There are lots of opportunities out there. What it requires is each one of us to be vigilant, to have the fire, to have the hunger, to have the passion, to go out and identify such companies and invest in them with a medium to long-term perspective. I think short-term investing is not going to yield the kind of returns that everybody aspires for. It requires patience. And I think there's basically a saying that you need two things to really be successful in long-term investing. Nazar and sabr. So you need to really need to be on the lookout for these kind of opportunities, and you'll need to be patient. I think finally what will end up paying the most is quality. There is really no substitute for quality. When we buy any product, any goods, any services for consumption, we focus on quality. I think investing is no different. Continue to be kind of biased towards companies which have good business models, good quality of management, sound balance sheets, preferably low debt. They have the cash flows, consistent margins to be able to invest. And I think it's also important to take a step back and be contrarian. There are a lot of sectors which have got beaten down, but I think that's clearly where the opportunity lies. So to that extent, I just say that stick to the basics, stick to the core, look out for well-managed companies, and be a long-term investor in this current environment of turbulence or chaos.
Welcome back. Well, me and Rima are here in Ahmedabad for the investor camp. It was a great presentation from Nilesh Shah. And here we have Prakash Tiwari with a very interesting approach, the Bollywood style of approach in stock markets.
It's quite commonsensical, and that's why I've decided to call it the commonsensical approach. All of us have these questions in our mind when it comes to picking stocks. First and foremost, any of us can do it. You don't need to be a financial wizard to actually pick good stocks. And Ahmedabad is a testimony to that. We've had some great investors come from this city. All one needs is good observation, the ability to observe what's around you, a high level of curiosity, which means you need to have the ability to ask questions. Keep on raising questions when you look at companies, when you discover companies, and seek answers to that. That's really going to help. But then, while it looks simple, it's not too common as well. What I thought is I'll make it very simple by comparing how a Bollywood approach to stock market would do, because all of us love movies, we understand Bollywood. If you were to put stocks in certain categories of which actors represent, how would the market look? So let's see, the big Bachchan category of companies. So the first is what companies which represent, if they were to be in that category of what Mr. Bachchan represents. Reliance Industries very clearly comes to our mind. Legendary status, has delivered across timelines, has its share of ups and downs, reputed to be a very focused player. They do, whatever they do, they take up, they do it extremely well. That's what even Mr. Bachchan does. They've been consistent and always believed in reinventing itself. he never goes out of fashion, and that's what Reliance also does. It keeps on moving into newer businesses, looks at promising areas, and you just cannot ignore it, even if it's not at its peak. The next category is the Salman Khan category. Now, what would I represent in this? Let's take a stock like Maruti. All of us love this stock, right? We love their cars, we love their stock. Highly dependable. It's never let people down. Any stage you buy in, you have made money, more or less, if not always. It has attained market leadership in its category. Salman Khan makes a movie, comes to the stage, does a 2-minute dance and takes crores of rupees. It's reputed to be a socially good player, being human is part of it. And it's instrumental in launching a lot of other players, right? If you know Maruti as a company, in the last 20 years, it's developed around itself as part of its vendor ecosystem at least 35 good companies, which have done exceedingly well. So Salman is also known for launching a lot of stars that we see in the market. Then you have the SRK category of companies. I'll quickly run you through this. What is this? I thought of a stock like Eicher Motors. And why is that? Available at a premium. SRK doesn't come cheap, right? It's attained market leadership in a very small area. All they do is what? Make Royal Enfield bullets. Shah Rukh Khan does a same style every movie, but still it works. Right? He still managed to get away. Aspires for a global acceptance. That's what Eicher is very clearly doing. It's gone into other markets. Has continued to surprise the market. At 1800, we thought Eicher was fully valued. At 5000, you thought Eicher was fully valued. At 10,000, you thought, both hai gaya hue to niche house hai. And at 19,000 also, there are people who are recommending. That's exactly what happens with stars like this. Then you have the Amir Khan category of companies. This is a separate, thing. So you have Mr. Dependable, as he's called. Focused and highly professional player. HDFC does what it is good at. It doesn't do everything and try to do anything. It always decides what's good for the market, industry, segment. It's a thought leader. Very conscious on quality. And they've been consistent delivery. People who have delivered, HDFC as a stock has delivered to all stakeholders, not just shareholders. High degree of CSR, of course. Then you have some of these stars who are probably not at their peak, but then you also have companies like that. Highly professionalized, disciplined, reputed to be a khiladi in its area of work, which L&T is. It's known to be very good in that work. Attracts a premium compared to its peers. Akshay Kumar takes a lot of money as well. I don't know if you know, but he's one of the topmost actors in terms of fees. It's accepted across investor classes. L&T has also done that, has built a track record of delivery, has always been very consistent. Currently, maybe not at its peak, not doing too well, but could always bounce back. Different actors will deliver different returns. You can't expect everybody to deliver same kind of returns in a year because it's a very stock-specific market. You will have actors having unique fan following. Some like it, some don't. So if you don't like a stock, don't worry about it. It's not necessary that, just because some fund managers like it, all of us have to like it. All actors have their ups and downs, hits and misses, so do companies. Reputation is of utmost importance. A track record is important. The management's quality is very important. And that's exactly what works. Delivery is the key to survive. If you can't act, you really can't make money as well. If you can't deliver returns to investors, nobody's going to like the stock. And you constantly need companies to reinvent themselves as much as actors do. Doing the same thing forever doesn't work. Look at Titan. It's no more top dog. It's no more where it used to be. So that's what I thought was very simple. And it's all about cause and effect. When you see big moves, there's always a cause. There's always a reason behind it. And what you see is the effect. Whether it's structural shifts, it could be policy, it could be earnings announcements, regulatory changes. We've seen the RBI make so many changes in the last 6 months on, related to NPAs, recognition of NPAs, treatment of NPAs, that banks have had a tremendous shift in terms of appeal and valuations. So those things are always going to happen. Corporate actions will always have some effects, so don't ignore them, whether an SR oil gets delisted, and if it does, at what price. All of it is going to impact things.
Now let's introduce our third speaker, Kapil Bali.
Both the economy and the markets go through cycles. So first of all, that is a hard reality which we know. So every up, when we are very high, we think this will keep going up, and we start hearing magical numbers, and suddenly we find that the next is we are coming down. And when we are really down, then we start listening to numbers which are really low, and then we start going up in the economy. So I think from an investor perspective, I'll watch for two factors. One is, and two simple factors, not too much maths around it, but two simple factors which are easily available to us. One is how to watch the economy, where we are in the economy, and which sector might largely give a guidance. So sectoral, I would say, is a guidance, the economy is a guidance. So from that perspective, I think the first is, easily available number is the GDP growth rate, which is highly public. Though the numbers have changed, so now the new number which will come is coming now. So it will start setting a benchmark. So we'll have a benchmark on the new number. Largely, I think once we start coming up the curve, we think that the markets, there is a weak recovery or a weak signal of recovery, which is when the GDP growth is stagnant. So largely we can say that if once the GDP signals are stagnant, we can say, okay, these are some of the sectors which can work. Then we move on to recovery, which may have different set of sectors. When we say performance of sectors, it is only the price performance here we are talking about. So it is just a relative performance to the broader index.
There are cycles both in the economy as well as in the market, because markets are a reflection of the economy. Depending on this cyclic behavior, the investor can look at the GDP year-on-year growth and take that as an indicator of which sectors and which phase of the economic life cycle we are in. Similarly, sentiment is a big factor in the markets, and an investor can look at how sentiments play different roles in different phases of the market. So should equities be still part of the long-term investor? As an asset class, if you see, we have the index has still performed even with whatever pessimism we have seen, and compared to property, which except in a few areas, which is locations, the asset class, equity asset class has still performed. Gold today is out of reckoning as of now, so the asset class is still there. So I feel if as investors we do our bit of homework and take small indicators into account, it's a long way off for us.
Let's take a break on that note, but up next, the most fun part of the investor camp, the Q&A. So come back after the break for that interesting Q&A session.
Welcome back. You tune in to the CNBC TV18 Investor Camp in this lively, bustling city of Ahmedabad. But it's the favorite time of the show. That's when you audience get to grill our three speakers. So let's kickstart that.
You didn't focus on the automobile sector as of now. And looking at the norms and all changing, do you think that it's right time to get in the automobile sector?
I think yes, this is a very interesting kind of times for the automobile sector. And you're going to see, as it is, I think a lot of emission norms, etc. were slated or scheduled for change. When you invest in an automobile sector, just keep in mind that relatively versus the car industry or the four-wheeler industry, the two-wheeler industry is a lot more simpler. There are less of technological challenges out there. There are just 2 or 3 evolved players, and as a product it's relatively simple. Penetration levels can be higher. As more and more urbanization happens, I think the two-wheeler industry within the overall pack looks better. The second way to kind of really invest in the automobile sector is to kind of look at some of the very interesting auto component companies. That as a segment is relatively neutral to any of these big technological changes, and it's relatively easy for them to adapt to the changes. And you're really not betting on just one company and its products succeeding, because the auto component company is actually supplying to many companies, irrespective of who wins or loses. And third is they have the export opportunity and cater to the global markets.
Why power sector is not picking up since last 5 years? Is there any chance to pick it up in next few years?
Power as a sector used to struggle. All these companies had shortage of fuel, that is coal primarily, and of course gas for some of the other units. But all that is now getting sorted out. I mean, the way you see every day there's progress being made. Another issue was nobody wanted to buy power because nobody paid up. I mean, nobody wanted to sell because nobody had the ability to pay up all your state electricity boards. So with that also kind of getting sorted out in some way, there's a start that Uday program has made. Hopefully all of that will translate into this thing. The only thing is, power as a sector will no more depend only on thermal power as the mainstay. So you'll have renewables coming in a significant way and very rapidly. Every day there's new progress being made on the renewable side. So you need to focus on both thermal and renewables when you talk about power. Whereas traditionally the companies that have failed or struggled are the thermal ones. So they will take time, but you'll have to be selective there. That's it.
Telecommunication is not seen here. As well as we are going right now for 4G, and many of the things is to be done in the next 5 to 10 years. So why this is overcome this?
I think telecom space is very interesting space, and what is happening in the country is phenomenal. And data, we have been seeing, data has grown phenomenally and growing exponentially in our country, which is infrastructure-wise very hungry even on the data front also. Some of these stocks are very interesting. The scale of those stocks is companies is amazing. And also, if you see the government's initiative on the smart cities, I think the biggest beneficiary should be the telecom industry itself. And this is going to be a reality. Yesterday or day before yesterday, Google's chief had said that Mumbai and the first station will be completely Wi-Fi free. I think this is a very small step, but coming from a person of that stature and a company of that stature, I think India is in a... So for a long-term investor, I think yes, it is a very interesting space. From a short-term perspective, maybe it may not be in the discussion as of now, but definitely from a long-term, we should have it in the portfolio.
Well, those were some really tough questions asked by the audience. Anuj, I think they do a better job than we do.
They always do at Ahmedabad, Rima.
Yes, what a savvy bunch. But until we meet again, here's bye from all of us from Ahmedabad.